Hello, everyone, and welcome to the Buck Stops Here. I am Catherine Murray. Well, if you've been watching the markets, you've certainly seen some great opportunities in terms of performance this year, but you've also seen, as of late, pullbacks in some of the most favorite names. And the question, of course, is what does that mean for the rest of the year performance and also into 2026? I'm thrilled to have a veteran with us on Wall Street and Bay Street, North American markets, and that's John Zechner. He's the chairman and lead equity manager of J. Zechner and Associates. John, great to be with you and have your perspective. You've been managing money for so long. So thanks. Interested to hear what you have to say. And why don't we start with just that? I mean, we have seen some incredible stock performance this year in various names. The market's done very well, both in Canada and the United States. And yet there's nervousness. How are you looking at it? And what do you think are the drivers of that nervousness? And are they real?
Well, it's interesting that you point that out, Catherine, because it has been a really good year for markets in general, and that's sort of as you go into year end is one of the issues, quite honestly, because you've had a lot of retail private money come in, and there's a lot of tax considerations there too. So what you've noticed as much as some of the rollover in the tech stocks is that anyone missing expectations or any of the losers are getting extra pressure, particularly in Canada. And we're seeing downward pressure on those because people want to crystallize losses. It's a year, we've seen with our clients where they've had a lot of gains. And if you can sort of it would take a few losses or get them off the books towards year end, you can mitigate what you're going to be paying in taxes next April. So I think that drives a small part of it. But on the other side, we've seen a bit of a rollover in the AI technology trade lately. And I guess it was a little bit of the expectations are so high, and you started to get that when companies hit great numbers, and then the stocks roll over. It tells you that everybody's in, expectations are high, and where's your next realm of buyers coming in? And that's always a difficult move. I think the action the Thursday after Nvidia reported earnings was a classic one-day reversal where you saw the market basically a 200-point move on the S&P 500 between the peak and the lows of the day, and it was pretty miserable breath. I mean, you saw a 3-to-1 decliners to advancers ratio, three times as many 52-week lows as 52-week highs. So that tells you there's some cracks in the market, and that's not unexpected. You got valuations at all-time high. Expectations are very strong. Sentiment is very positive. Cash is at an absolute low. You've got the biggest participation of retail investors ever, particularly in the U.S. market, with over 70% of their financial assets held right now in stocks, which is a record. So when you get those type of metrics, there's no room for error. There's no room for disappointments. And then you start to shoot a couple of holes in the great story of AI. You start to talk about, hey, are the depreciation schedules a little bit too aggressive? You know, these companies are suddenly generating negative free cash flow and having to get their financing going forward in the debt markets. Is OpenAI at 500 billion? Is that a reasonable valuation? So questions come up like that, and people will sell first, ask questions later, especially if they've got, big wins.
Yeah, well, and those are, a lot of driving forces that you point out to show that the market should be trading lower. And what was so interesting, though, to see was that on Monday, yesterday, we saw the market rally. So it's very difficult, I think, John, to decide. And you're an expert in both trading, but also being a long-term investor and a fundamental analyst, in my opinion. So in the scenario that you just indicated, what do you do or what do you recommend?
I rolled out the 2000 playbook on this one, Catherine, and I sort of in a similar situation where valuations were stretched. There's a lot of momentum to the upside. I don't necessarily want to get out of tech altogether. We never would, but we certainly have a much reduced weighting there, and none of the high flyers on the AI story. Even like the core weaves and not even oracles and names like that, and the chip sector we've taken it down dramatically. And yet, we're keeping an equity weighting, and I've picking up some of these, tax loss selling losers in depressed sectors where I think the valuations are attractive and there's still some growth and there's very little downside. So, and that reminds me of what we did back in 2000 of, what you're looking to do is you may not beat the market on the up days. You just want to participate on the up days. On the down days, you're going to sort of pick up gains on the market. And that's sort of a strategy overall. So, yeah, that's probably a good strategy for overall investors. And I think whatever you decided your fair equity weighting is, should probably be at the lower end of that weighting. Not be out of the market altogether, but look for downside protection right now.
Okay. It's interesting because some people would say we're not quite like the 2000s. We'll take a quick break. We'll be right back.